next, we have Nexstar. Nexstar Media Group is headquartered in Irving, Texas. It's the largest local broadcast television group in the United States. Following the acquisition of Tribune in 2019, the company owns or partners with over 200 broadcast stations in 116 markets, reaching approximately 70% of all U.S. TV households. Nexstar also owns NewsNation, a national cable network, and has a 75% majority stake in the CW broadcast network. The company has about 30 million shares, trading around 165 for a $5 billion equity market cap, $6.2 billion of net debt for about an $11.3 billion total enterprise value. Today we have the company's president and chief operating officer, Michael Biard, and chief financial officer, Leanne Gliha, with us here virtually. Thank you both so much for joining us.
Thank you. Happy to be here.
So I'll start off with some of the topics we covered last year to see where we are. We discussed the Charter-Disney standoff and your broader thoughts around implications for broadcast. Over the course of the last year, we've seen companies with broadcast assets outperform those, and we've seen large media companies like Comcast and Disney who have explored ways to create value by spinning off traditional cable network assets, retaining their broadcast assets, things like that. Seems like would indicate a positive trajectory for broadcast. So as we sit here in 2025, how is your thinking around broadcast role in the ecosystem changed at all? And with streaming fragmentation continuing, is broadcast scale and reach even more valuable?
Sure, I'll take that one. I think when you look back on the fall of 23, because you referenced the Charter-Disney kerfuffle, we looked at that and took a few things away, not just from the fact that there was a conflict, but more from the resolution of that conflict. And just briefly, a few of the highlights that we saw was, first the fight wasn't over valuable programming, right? You didn't see Charter anywhere in their materials, and if you recall, they came out with a very thoughtful deck. I didn't necessarily agree with everything in it, but it was very thoughtful, and there was a lot of great points in there. And nowhere in there did you see them really taking issue with the value of the what we consider the premium programming inside the Disney portfolio, right? They didn't attack ESPN or ABC, for instance. And in the end, that premium stuff got paid. Second, one of the things you did see Charter going after was the value of the long tail cable networks, or really the lack of value thereof, right? The sort of stuff that nearly every objective observer looks at today and says, these things really aren't providing value into the cable bundle. And if you recall, when the deal got done and the Disney networks were relaunched on Charter, there were a few that didn't come back. These were largely derivative networks that were, sort of derived from their leading brands, and they were left out when the deal was struck. The third, and this was really a critical piece for us, was the D2C services were brought back into the bundle for the first time. Right, allowing Charter to bundle D2C with their linear video that they sell to their subscribers. And that was an important milestone from our perspective, because it essentially marked the end of an era where programmers could act as if they could sort of benefit from the bundled linear video business that was essentially paying for all the D2C services, while simultaneously kind of undermining it with what they were doing with their D2C services. And we thought then, and we still do today, that those takeaways were all positive signals for broadcast. Right? Nothing is more premium or more valuable to the bundle than broadcast, right? Even versus ESPN. Right? We think the culling of those long tail cable networks was really a good thing for us as well. Taking cost out of the system where there's no value coming back in, good for consumers, and frankly, good for us if it frees up dollars to be reallocated to services like ours that we think are really delivering the value to the bundle. And third, the idea that the D2C services come back in is a good thing from our perspective as well, right? Eliminating the temptation for programmers to take programming away from broadcast and put it on a D2C service. And frankly, it kind of provides the opposite incentive. If you think of D2C services and linear now being brought back together, if I'm a programmer in a major network, I want to put my big programming on the broadest reach. I don't have a temptation to sort of separate it to try and get paid twice anymore. And so I'm going to put it where I can get the most advertising benefit. So those all of those things at the time we thought were good. Nothing in the interim has changed our mind on that. And as you referenced at the beginning of the question, what we've seen since has only strengthened our point of view on that. Developments at Comcast by shedding their cable networks, kind of refocusing on broadcast as kind of the centerpiece of their video strategy. You heard from the Skydance folks when they announced their Paramount acquisition that CBS was really critical to their vision of the future of that business. And I think finally, if you think about what Fox has announced with respect to their D2C product, they've been very express about saying they're not going to chase original programming for that product. They expect to deliver it as part of their bundled video that they provide to the pay TV business. And I'm not sure if they've said this, but we can say that the full-time feeds of their affiliated stations will be included inside that product.
Great. That's a really helpful overview. And we've talked a lot about the potential for deregulation in the broadcast space under FCC Chairman Brendan Carr. What's your take on his early policy direction, and what do you see as the largest benefits to the broadcast ecosystem if some of these changes go through?
Well, I mean, candidly, it's been a breath of fresh air to have an FCC chair that understands the value that broadcast, and in particular the local station, provides to the community. And we're grateful that he understands that the regulatory scheme around broadcast is really an abject anachronism that needs to go away. Chairman Carr has been refreshingly practical and modern in recognizing that there's something seriously broken with a system that says a company like Nexstar and fellow broadcasters can't grow because we're capped, while big tech and big media, with whom we compete both for advertising and viewers, can continue to grow without constraint of any kind of similar regulatory scheme. So the chairman has brought an urgency to the situation that frankly is long overdue, and we're grateful for it.
Great. So Nexstar has been right up against the cap for some time now, and you're the largest broadcaster in the U.S., as I mentioned in my intro. Share your thoughts around M&A opportunities and areas of interest for Nexstar, in particular from where we sit today and timing in light of the potential deregulation that you see coming. How do you see Nexstar participating in further industry consolidation from here, and kind of what are your biggest focus areas?
Maybe I'll jump in there. We've been historically, we've created a lot of shareholder value through our M&A strategy. You kind of go back in time and you look at where our stock price was at the beginning of 2011 and where it is today. We did that through, I think over 20 deals, including doubling the size of the company in 2017 with the Media General acquisition, and then doubling the size of the company again in 2019 with the Tribune Media acquisition. And that's really driven a lot of good synergy for us. We have a number of layers of synergy that come to us from M&A, and that includes retrans synergies, in-market operating expense and station level synergies, and then corporate overhead synergies. And so it can be a nice way for us to grow our free cash flow and be accretive on a free cash flow basis, more so than just buying back our stock. So I think we'll have to see where the FCC goes in terms of deregulation, because as you noted, we are at the cap today, and so we would need relief in order to expand into new markets that we're not in. The other component that has been talked about is providing some relief in terms of the in-market duopoly rules. Right now, you cannot own two of the top four stations in a market. If there's relief there, that would provide additional ability for us to make acquisitions in the markets that we're currently in, and frankly provide kind of a new level of synergy if we're able to do that, which would be interesting. I think that given our success in this in the past, we're gonna look at all the opportunities that are out there and try to find the ones that we think are the best for us. Clearly we would have an interest in markets where we can put more CWs on, markets that are a little bit bigger, markets where we currently have a presence. But all of that boiled down, we can want what we want, but there has to be a willing seller and a willing buyer to make a transaction happen, and a favorable regulatory environment for all of that to come together. So, we'll have to see. I think the first thing we need to have happen is for the FCC to get in position to, make some moves in terms of the deregulation that they've been talking about, and then we'll kind of follow on from there.
In terms of timing for that first piece on the regulatory side to get into place, what are you anticipating now in light of some of the developments we've heard this week and the potential confirmation of the next Republican commissioner? What are you thinking about in terms of timing?
Look, I think our expectations are that, once the FCC gets into a position where there's a Republican majority, that we would start to see some action. Brendan Carr acting on, his agenda at that point.
That's helpful. And then in terms of the 3 buckets of synergy from consolidation that you mentioned, what do you see as the most impactful from where we sit today? I think you mentioned retrans synergies, corporate overhead, and there's one more.
Oh yeah, the in-market synergies. So
Yeah.
to the extent that we or just general operating synergies at the station level. I think they're all very impactful. I think it just depends on, the target company and which is going to be, more impactful to us. I think if you go back, we've provided a lot of detail historically and sort of the 3 buckets.
Mm-hmm.
If you could, on our website, we've got our old investor decks from Tribune and Media General, so you can kind of see how that kind of pencils out. But they're all 3 of those. Those categories can be impactful to us.
That's helpful. And so continuing with retransmission and kind of the scale opportunities, as the largest local broadcaster, you obviously have pricing power to raise your rates, but that's been offset by subscriber declines. Can you share your outlook for retransmission from where we sit today and kind of where we are in terms of the payment cycle relative to where it may go?
Sure, I'll jump in. I don't want to agree that we have pricing power. I think that's a term of art in some circles that we don't necessarily agree with. We certainly have enough scale to be taken seriously, and I think the heart of your question is really one about scale. And the media business, and particularly on the distribution side, has always been a scaled business. And but notwithstanding sort of our ranking as the largest broadcaster, as I mentioned before, we're in a world where we're competing with big tech all the time. And so, more scale is always better, especially if you consider who our, competition is. And, as Leanne mentioned, as we think about, M&A, scale not only provides negotiating leverage, but operating leverage as well, which is, critically important to us. But with respect to your specific question on retrans, I guess the answer is we'll continue to pursue a share of the wholesale fees that better reflects the share of the value that we deliver. And if you just think about it from a ratings perspective, right? If you sort of compare share of wallet, right? What percentage of fees do we pull out of the system versus share of viewership? What do we deliver back in? There's still a disparity there. And we think that disparity is on the order of about 40%, right? So there's 40% upside to our retrans if we got those 2 things to sort of level out. That's kind of been the marker that we've been pursuing for some time. We think there's still upside there, and we'll continue to pursue that going forward.
That's helpful. And then just closing the loop on potential regulatory relief, there's a few other areas that have been floated. I mean, anything impactful or meaningful, likely not quite as meaningful as changes to the cap, but in terms of ATSC changes or potential reverse retrans payments, that sort of thing.
Sure. Let me break this down separately. So the notion that reverse retrans payments are what affiliated stations pay to their networks, the notion that that's going to be capped or regulated, that came from one commissioner, in fact, who will retire as of tomorrow, or resign as of tomorrow, in an op-ed. So I guess we haven't seen a lot of traction around that idea, and we don't spend a lot of time really thinking about that as being very operative. On the ATSC front, yeah, that is important, right? The idea that, and this is a proposed rulemaking that the NAB has proffered, right? The idea that there'd be a mandatory cutoff date, converting from 1.0, the current technology, to 3.0, making everything that we do over the air a lot more efficient. We think that has a lot of legs. Actually, should be adopted, and coupled with that, a pretty quick end to the idea that we have to simulcast right now what we put out on our primary signal on 1.0 that we have to simulcast that on 3.0 as well, right? That's just duplicative. It's inefficient, and it's taking up, basically spectrum that we could be using for other purposes.
Mm-hmm. That's helpful. So moving on to sports, Nexstar's diversified its mix of sports programming, including the Big Four affiliate sports, CW sports, and local sports. Talk a bit about the benefit of broadcast model to sports and how you think Nexstar strategy around sports develops from here.
Yeah, I guess I'll start with the headline that we think, fundamentally, broadcast television remains, the most important medium for engaging live sports audiences, right? I think you could just look in the last year and see, notwithstanding all of the rumors of the demise of broadcast TV, it just keeps chugging along and actually setting new records, right? You look at the Super Bowl, what it did this year, Kentucky Derby, just a couple of weeks ago, the Indy 500 set, basically a new record for the last, I think it was 19 years or something like that. Final Four, right? The Masters, the NFL draft, all of these things, centered on broadcast. Some of them with a little bit of streaming augment, but you don't see any stories like that written about events that are exclusively on cable, right? The new records that continue to be set are, centered on the cornerstone of their distribution is broadcast. So we like where we are in that regard. So if you think about our portfolio and sort of break it down into three different buckets, right? One is we get programming from our Big Four affiliated networks, right, on our affiliated stations. We don't really have anything to do with the acquisition of that programming, right? We look at how it's distributed to us, how much of it is exclusive and so forth through the network. And then that, of course, factors into, what is in fact a complex and pretty multifaceted relationship with the networks. The other two buckets, what we have on the CW and then what we acquire, on a local basis for our stations, of course, we control those directly and, look at the cost benefit, and we're pretty judicious about what we do in each of those markets. But the common thread, I guess I would point to in each of those is the platform that we offer our partner, whether it's a league or a team or a conference, in each case, really one of the benefits that we offer them is the unparalleled reach of broadcast, right? And there really is no other platform that can match that. And frankly, we recognize that that's an asset, and we use that as consideration, right, in the negotiations that we have with them. I think every league, every league or conference out there thinking about broadcast as a distribution platform increasingly recognizes the sort of preeminent place that they hold, right? The sort of history of alternative platforms, whether that's cable or streaming as an alternative, is now long enough to where every rights holder can sort of look back and see, okay, that was a good deal or that wasn't a good deal, right? And in the case of MLS going exclusively to Apple, I'm not sure that's turned out, to be a great deal for them, right? I think others looking at streaming and thinking about, okay, there's a big check available there, but is that really fundamentally going to help me grow my brand, grow my product, grow my fan base, which of course is the lifeblood to all of them. And I could go on, but the fact of the matter is when you compare sort of that hit list of successes that I mentioned on the broadcast side against what's happened on the other side where events have gone exclusively to streaming, we see a drop off on the order of typically around 20%, right? Whether that's NFL on Netflix or, NASCAR on Prime or Thursday Night Football, typically you're not seeing, anywhere close to the sort of year-on-year comparison. You're seeing a pretty significant drop-off.
Yeah, so you went ahead and answered my next question just about the role of broadcast in sports distribution with some of the streaming players coming in. So I think we can start to move on a little bit to the CW, and you mentioned the CW and kind of some of the programming changes you've made there. Can you touch on the importance of the CW to Nexstar and the opportunity that you see there?
Sure. I guess I'll start with the importance of our 54 CW affiliated stations, right? Because that really is a meaningful business for us, and it, if you think about the reason we're in the CW business is because we were, the largest CW affiliate when that business came to market, 3 years ago. So while the CW as a network may not be the most material contributor to the finances of the company, the stations are increasingly important to us, and certainly the CW as an asset is a strategically valuable asset, right? It gives us the ability to control our own destiny on a vertically integrated, network all the way down through. That allows us to, by comparison with the big four networks on the CW, we can control, every platform we go to. We have a seat at the table with every distributor for carriage of our stations, whether that's a virtual MVPD or traditional one, right? And then having control of the programming allows us to program it in such a way that it benefits broadcast, which in fact is the business that CW's always been in, but its partners were in different businesses, and that obviously drove different strategic decisions for them. So by being able to, sort of transform the programming, away from, niche comic book and other superhero programming and into programming that resonates with the broadcast viewer, starting with sports, we obviously have an opportunity to grow our distribution, grow our advertising, and really make it a business that is positioned in a much different way.
That makes a lot of sense. And then can you also just touch on News Nation and the longer term opportunity that you see there?
Sure. I guess the common thread with News Nation and CW is, those are businesses that we were, kind of adjacent to, and then we've transformed them in a way to make them a better complement to our core business. In the case of, CW, we were an affiliate, as I just described, and then, took over the network and transformed it completely. In the case of News Nation, that came to us as WGN America through the Tribune acquisition in 2019. We looked at that and thought that the world didn't need another general entertainment network that was focused on original scripted programming, trying to compete with, big tech and streamers and other big media in that regard. What we thought it could benefit from was, a fact-based, nonpartisan cable news network, right? And that's in the wheelhouse of what we do as a company, right? I think we employ the largest number of journalists across the country, over 5,000 journalists. We do news better than anybody else, certainly at scale. And we thought that, a cable news network would resonate, with the characteristics I just described, would resonate with viewers. And we have the ability to actually execute on that in a way that nobody else does, given the fact that we have, local news in hundreds of markets around the country. So, it's a business that is still growing. If you look at, quarter on quarter, month on month, certainly at the beginning of this year, we see, growing ratings. If you look at, the fact that we've only been 24/7 news for about a year right now, it's still very much in a growth cycle. Notwithstanding that, we had the last Republican debate last year on News Nation. We're increasingly going head to head, with the established brands that have been around for, 30 to 40 years. So we feel good about the trajectory there, and certainly are proud of the product that we're putting out every day.
That's helpful. And just want to make sure that we touch on core advertising trends and then also political. Can you just tell us what you're seeing in terms of your portfolio and the advertising expectations from where we sit today? Any categories that you see as the largest opportunities or risks moving forward? And then from there, we can talk a little bit about political and how you're positioned to benefit in the upcoming cycles.
Yeah, so on the core advertising side, our non-political advertising, just to take a step back for, half a second, about 70% of our non-political advertising comes from our local advertisers, which tend to be, more stable, more call to action type advertisers, and tend to be, more stable than the national side of things. So the lion's share of our advertising comes from that segment. If you also sort of look at our overall advertising pie, you've got about non-political advertising pie, about 20% of that's coming from digital, which has been on the local side nicely growing for us as we see, continue to see growth in that area. When you sort of look at our pie and you break it down by categories of advertisers, you're going to see about 60% of our non-political advertising is coming from services-based businesses rather than goods-based businesses. I know there's been, some concern about, supply chain with respect to tariffs, and really when you look at our pie of advertisers, it's very diverse, and it's segmented, like I said, 60% services and 40% goods. So when you look at that, our biggest advertiser is auto, but our second biggest advertising category is attorneys, which is not really kind of supply chain focused. What we've been seeing, in the first quarter, I think our non-political advertising was down about 4.2%, and we guided for the second quarter on our last earnings call down again in the low mid single digits, similar to the first quarter. So we haven't really seen kind of a major fall off or a big change in sort of the overall advertising industry or sector as a result of what's been going on from a tariff or a macro perspective. The categories that tend to be a little more difficult for us as of late have been auto and insurance. And so but there's not really anything else to kind of call out as, anything that's sticking out as, particularly impactful to our overall numbers. So we're feeling, we feel pretty good with our overall advertising portfolio and the base that we've got, and, the resiliency of the relationships that we have.
That's helpful. And then on the political side, as we move into the back half of this year and then into 2026, how are you thinking about political versus, I guess, the last midterms as well as 2024?
Yeah, I'll jump in there. I think you start with the nature of our footprint, right? And our footprint is so extensive. We typically have a presence in like 80 to 90% of the contested markets, right? And so that gives us a level of stability and sort of expectation that year on year we're going to garner typically about the same share of the footprint. I mean of the spend in our footprint, right? Think of it about low teens, right? And so as the overall spend in television continues to grow, and we saw it grow in the 20 to 24 cycle, the presidential cycle, our percentage of that pie was consistent. So we expect similar trends will continue into next year, both in terms of the midterms and then into 28 as well.
Great. Any audience questions? There's one in the back here.
Hello. Yeah, thank you. How much of a risk factor do you see for you guys, those standalone streaming services like Paramount, Peacock, and now Fox just announced Fox One, where they're basically just giving the broadcast feed for a lot of these in a lot of markets? Is that a factor for you? Is it a concern? And forgive my ignorance if I don't understand the model there in terms of if you guys receive any retrans from those subscribers to you guys.
Yeah, I'll take that one. Each of them is a little bit different in terms of how they're structured and both in terms of the business model with us and the role that our affiliated stations with each of those networks plays inside that product. So let's start with Fox because that's the one I know best, given my history. Fox will come out with a product that will include, Fox Broadcast, but Fox Broadcast is only expressed in each market today through their local stations, whether that's an O&O station or an affiliated station. And so when you buy the product and open it up and watch Fox, what you're going to see in each of your markets is the feed from those local stations, assuming they've gotten a deal done with each of their stations. And I can tell you that we expect to have a deal done with them in that regard. So you will see when you're watching Fox Broadcast, NFL on Sunday, for instance, if you're in a Nexstar market, you'll see our station. If you're in a gray market, you'll see theirs, assuming they get their deal done. And if you're in an O&O market, you'll see that. So there is an economic relationship between us. So yes, we will get paid for each of those subscribers. We have a similar relationship with Peacock. Peacock has a little bit of complexity because they have two different tiers of product. one level does not include the local stations, including their O&Os. The other does, includes the O&Os, and it includes ours as well, and same with Paramount. So the economic relationship as it relates to the D2C products is one facet, as I mentioned before, of really a complex relationship that we have with our networks, right? There's a lot of moving pieces in terms of the sort of puts and takes in that relationship. Ultimately, at the end of the day, I'll come back to the importance of broadcast, because I think your question is, do we see those as a threat? And I guess the way I think of it is, those products are centered on their broadcast networks first and foremost. And if they move away from broadcast, well, we know what those models look like. If they want to do deals directly with the distributors and make the content, sort of bypass broadcast, well, we know what that model looks like. It's called a cable network, right? And if they want to go directly to consumers exclusively, we know what that looks like, and they can go compete with Netflix, right? So they are doing an augmented, right, version of both of those. But to be a broadcast network and reach the entire country, and again, that reach is really the secret sauce to the rights that they're able to acquire and the viewership that they're able to garner. That requires having affiliates in every market, and that's where the role that we provide and our scale, coming back to that question, is really a critical asset of the company in all of those discussions.
Great, thanks. I think we're about at time, so we appreciate you joining us again this year, and we look forward to having you again next year.
All right, thank you.
Thanks so much.